Hello, thanks for tuning in this week. Episode 5, Energetic Incorporated. This is Kevin Bambro, and I'm very pleased to have my guest, Larry McDonald, joining me, author of How to Listen When Markets Speak is his recent book, and he also has the Bear Traps Report. Anyway, great pleasure. Hope you enjoy, and don't forget to like and subscribe.
We just did New York for 2 weeks with the family, and it was like, if you breathe in New York, it's like $1,000 per breath. Now I'm just back in Panama, kind of working with the family offices in a couple weeks.
I've read your books, and the advice you give is it's great long-term advice as well as very specific, especially in the latest book where you're talking about the cycles. And I'm trying to sort of focus on the process behind coming to the decisions that you did. You know, the looking at like, how do we look at cycles? I'm sort of bridging the gap between health, psychology, finance. I guess one of my motivations for doing what I'm trying to do now in the book, there's so many false narratives out there.
Yeah.
And if people buy into a false narrative, they're going to incorrectly allocate their capital. And at the end of the day, if we want to have a productive society, we want to have a good economy, we want to have a good political system, whatever it is, you know, you have to allocate capital correctly. Otherwise, you're creating problems, right? And some people are preying on other people. And if people are misallocating capital, you're going to have waste, right?
Right.
And misery and anger. One of the little clips I put out the other day is I said, most people won't like my narrative right now, unless you're a defense contractor, right? Like it's an upsetting narrative that I put out. And anyway, so on that, I mean, I really appreciate you doing this. And I guess one of the things, just knowing the framework I'm coming from here is I want it to be sort of timeless. And I look back at, and why I'm interested in talking to you in particular is I've read both your books. And it's funny, some of the stuff that I read when I was doing my own sort of self-help and research on how to fix my frustrations and you know, me investing my energy in the wrong places. I read a lot about trauma. And so I started to connect the dots with people that have financial trauma. And when you read a lot about trauma, they also tell you if you're going to talk about trauma, you have to ask someone's permission first before you bring up trauma. And so you've written about your financial trauma with Lehman Brothers. And so I sort of would like you to just give us a sort of a tight summary of what a day in the life was like for Larry pre-Lehman blowing up. Sort of like, what were you actually doing, like as a convertible bond trader? Meanwhile, this other stuff's going on at Lehman and it blows the firm up, right? And you're obviously, and you suffered this loss, right? So it's like a big chapter change, right? Before and after Lehman, right? So just sort of frame us on that in that first book and why you wrote the first book as your comeback.
Yeah, the first book was, you know, you're inside this incredible firm that was one of the best places to work in the world in that 2000 to 2007 period. The firm was heralded as one of the best places to work. Really spent a lot of time on diversity, and not just diversity, but more like working with inner city kids on the trading desk. We would do this religiously on a regular basis. At one point, I got an award for that. So I was constantly trying to give back and give back and give back. And then, but you realize that you're peeling the onion back over the years, and you realize you're staring at the skull and crossbones. Like, in other words, there were so many incredible things within the organization, but there were some really bad people that were at the core, and that didn't have much connectivity with the rest of us. And so day to day, it was like, you know, I'm a trader. I was learning a lot about hedging, and all that means for people, it's just like, okay, we're doing bond deals, and our team had to hedge that. In other words, protect the firm from any kind of market risk to those positions. So I learned an awful lot about hedging, and we created what we have today as our 21 Lehman systemic risk indicators, and it all goes back to those days. And then when Lehman went down, I wanted to bring that unvarnished tale to the world, but I also wanted to help other people understand about deception, about corporate governance, and just kind of get the truth out and help a greater, larger audience understand what really happened. And because this was like a $700 billion bank failure that when that hit the waves of the planet, it just affected millions and millions of people around the planet Earth.
And so the actual big losses that caused the blow up, if you were to try to explain it, you must have been, hopefully you could explain it in very simple terms, like what actually happened that led to that blow up.
First of all, the board was in the back pocket of the CEO. And so you had horrible, horrible corporate governance and oversight. And then the CEO had tremendous, tremendous control over the executive committee, over the positions of the firm. And it just became way too concentrated in really risky assets. And they thought they would have lots of liquidity. They thought that they'd be able to finance these bad, illiquid assets. And it was just, the classic mistake that some banks make is where, you're long the illiquid. So you're long something that's not, all that means is you can't really sell it that easily. And you're trying to finance it, in the markets, in the repo market. All that means is that you're trying to finance it overnight or over short periods of time. So you're trying to finance a very illiquid, billions and billions and billions of dollars of illiquid assets in what we call the overnight market or short-term borrowing market, and that works for a long time, and it's very profitable if you can do it. But when that liquidity dries up, and you're forced to sell your assets at a time where it's like fire sale and there's no buyers, and all of a sudden you can go from being very profitable to losing billions and billions, hundreds of billions of dollars like that.
And it's sort of like, I guess there's two elements there that things go wrong. Is one is you've got a mark to model, and then there's the mark to reality comes through when there's a liquid market. It's very different between somebody could say, oh, these bonds are worth this, they're going to get paid back someday, but you have to market to reality, and you've got negative equity, right? And you're bankrupt.
Right. And I see a lot of this today in private equity, private credit, is there's, the mark to market, mark to model, mark to myth. And that's, what Buffett talks about. When I sat down with Charlie Munger at Omaha, he said, Larry, never forget the 3 M's, mark to market, mark to model, mark to myth. And I'm like, wow, that's pretty cool. And I'm worried today about private equity and private credit because it's very similar. There's a lot of money in there. There's a lot of wealth, and it's a problem, Kevin, because you've got a great sniffer. I mean, I've known you, I guess, that 5 years now, and I can just tell as a trader when you see these products come up in the business where all of a sudden they're sucking in the little guy, and at the same time, if you really look carefully, they're actually providing liquidity for the kind of the senior investors or whatever to get out, and that's typically a bad recipe, and it means that there's something coming.
Or with the private credit market, they're just playing a weird game of I think I told you, by the way, I think I mentioned before that I left Sprott because of a strong. I strongly oppose, and I'd shut down some of our private credit products. And then there was a decision made to reopen them, and it was being made at the executive level because of a lack of liquidity in them. They could not meet redemptions. So senior management overruled me, right? Between the board and people under me went above me and overruled and said, we're opening up this product and we're going to sell it to let money in, to let other money out, because they didn't want to gate the product. And I was completely against it. I was very, very upset. You can see even I get worked up still about this. And this is sort of what I get into, is that I'm sure there was a time period for you leaving Lehman. You're like, you must have been angry or frustrated, having lost all this money. But you had this education in history and style and performance method that you're like, I'm just going to get back to doing what I know how. And you actually moved from bonds to looking at equity, stocks, cycles, all these other things. And you retrained yourself, I guess, in in a certain way. You've added a lot of skills and then went on to build this business and write books, and you've done fantastic. And there's obviously something in you that you're wired for the comeback, right? Whereas one of the things I talk about in my book is epigenetics, and that when you have strong aversion, if you have suffered trauma, some people would suffer severe losses and be like, I'm never touching stocks again. And this happens, you'll see this in a lot of families where, oh, granddad lost the family fortune and was thrown out of the house. And, we barely touch stocks. We don't believe in that. And generations will hold that view because of such a severe trauma and memory. Anyway, I try to frame this back to a question of how do you think, is there some way to sort of touch on, like, there must have been a period of time after, like, the shock of the loss, and then having to be like, okay, what am I going to do? How am I going to reinvent myself? You dug down deep and started figuring stuff out. And I always say people hunt for neurochemical pleasures, and you must, like the game, right? You dig into stocks, you dig into research, and you get, it excites you, right? And it's enjoyable, and you keep going because you love that, right? Like some people would hit the bottle when they hit a lot of losses. And anyway,
Yeah, no, that's it. I mean, there's a scene in one of the last Rocky movies where Stallone is with his son, and his son was complaining about some adversity. And Stallone's point is this has always been a driving core inside of me. It's just, it's not how much you get it. It's about getting hit and keeping moving forward. It's about taking the hits and a burning desire inside to break through those walls of resistance in the universe that everybody faces. And everybody faces these things and lets that resistance impact their psychology, impact their personal being, makes them feel depressed. To me, it's like there's a raging furnace inside of me that when I get that garbage, I want to punch through that wall, because in the end, that's what winning's all about. And whether it be, I started this company from scratch. Now we're up and running with the greatest hedge funds in the world. Like, all the top hedge funds are pretty much our clients. And it's one of the toughest things to break into those types of businesses, because the resistance is really hard on a compliance level, right? You might know the CEO, but if the traders don't trust you, you're not going to get in there. So you've got to break through at the high level, the trading level, and at the compliance level, and break through all that resistance and get them to trust you. And then when I did the first book, we did 140 speeches in 16 countries. And the best part was democratizing information. In other words, building those relationships with people around the world that can become your mentors. Imagine having like 50 Kevin Bambros as your mentors. You've been a great mentor to me in commodities. And imagine having 50 of those guys across corporate credit, across foreign exchange, across Eurodollars, FX. I'll call it SOFR futures now instead of Eurodollars. But learning from like 50 or 60 Kevin Bambros. But I had to go to London 8 times in the last decade to build those relationships. I had to go to Toronto. I had to go to LA. I had to go to South Africa. I had to go to meet all those different people, get them to trust me, and then take that intelligence gathering, put it into a research product, and democratize the information. I want to give that broad audience a lens on that kind of special conversation with some of the best investors. And it's a really burning desire inside of me to do that.
Awesome. That totally clicked with me when I picture that. So one of the things when I picture what you're saying in what you actually did and how you operated, one of the things that I've been writing about is I really dug into this biopsychology. And by the way, my book, I sort of refer to our human body, as being like a biological supercomputer. And when you break it down and you start looking at how our brains work and how our cells are actual, like, what makes you shift your focus from here to there, right? People for years or decades, for centuries and thousands of years, people have speculated, philosophers have speculated on, how does the brain work? Is there the soul, the spirit, whatever? Religious people have, had their opinions on everything. But when we look at it on a cellular basis, it's the clustering of neurons. And you have this global conversation that occurs at the peak of your brain, your consciousness, which is sort of like, I like to point out that your focus or where your attention is like what's trending on Twitter. It's what the most neurons, if you think of neurons as being cells and humans all around the world as being like cells, they're all connecting on the internet, and whatever they're most excited about and researching or looking at or interacting with, that becomes the most trending item. And then we're all, as individuals, we sort of go onto social media and we look and we go, oh, what's trending? And we focus there because it's interesting to us to see what everyone else is looking at. And that same, I call it like it's a fractal. The same thing happens in our body. So you have in your subconscious mind, you have these little clusters forming, and they come up, they might be working on, oh, this is, what do I got to do this weekend for the family? And, you got a little subroutine going here, remembering that it's your wife's birthday or it's Mother's Day coming up or whatever. And then over here, you've got, some other work being done on the markets and these people that you've connected with around the world. And if you think about what the relationship you built with these people, it's literally like a cluster of cells working on this big problem of the markets, right? And you could, by tapping into all these other people's networks, you've created a system by where you're getting all this information from all over the world, and you're able to process it. And sort of the smartest, most informed, most connected people at the system are like the highest level neurons in your head that are coming up with the solutions, or how we should position ourselves.
Right.
Now, when I dig into that, one of the things that I sort of look at is, and I wrote about it, but by the way, the cells work, right? It's amplitude and frequency.
What's it called?
Is actually when our cells talk to each other, they communicate electronically, right? And that's why you need energy. You eat right. If you go and exercise, you breathe, and you get your muscles going, and you actually recharge the ions in the atoms, in the molecules in your brain, and you can process things better. When you're exhausted, you're like, I can't think, I don't even want to decide what's for dinner. Let someone else pick because I'm just exhausted, right? You're actually low on ions. And anyway, when you think about this and the way the cells and the neurons and the activity, the way our brains work, it's amplitude and frequency. So it's, if you imagine you're at one of these investment conferences and it's at the start of the day, people start trickling in, and you start seeing people cluster up, the people that know each other, right? And then one group could start getting excited and laughing or being boisterous or whatever, and it grabs the attention of the other people in the room. They stop talking and they look. And that's what happens in our brains, is a cluster starts working on something that's very important. And it could even be like, oh, shoot, I forgot it's so-and-so's birthday today, or it's, daylight savings time. And then you're just focused on what you've got to do, right? Or you get triggered, like, this is a major market event and everything drops away and you're like, I need to buy and sell this or that or whatever, right? But these cells, there's no top-down control. It's literally the cells kind of light up in a cluster and they grab the attention, like somebody walking into that conference room and screaming that there's a fire, or shooting off a gun, like a bang, a loud frequency, somebody screaming. They're going to draw the attention. Everyone sort of forgets what they were thinking about or working on and looks at, where's this loud person? And they could be someone on the microphone at this, hey, everyone quiet down, right? And then you hear, they're boring, right? They're talking low, they're boring. The group in the back starts rumbling, and that's literally like a cluster forming, deciding not to focus on their attention on the speaker, but instead they're more interested in their own discussion, and they could take over the room if they started yelling and being boisterous, right? The point being is that when you understand that sort of framework and you see there's people like you that are going around the world and you're connecting with all these people and trying to gather information and do real work and figure out what the hell's going on in the world, right? And I always like those videos you put out. You're like, so this is what I figured out here, But then you've got people like the Trump administration who come in and they get the world's attention the same way that if you're walking down the street thinking about the markets, but you step on a nail, a couple of just a nail shooting into the cells in your foot, they scream with high amplitude and frequency pain, and it gets your attention. You stop focusing on whatever you're focusing on and you focus on the pain in the foot. And so when the Trump administration decides to just slam tariffs and cause all this pain, everyone's focused on them. Everyone focuses in on the source of the pain. And it literally comes from just one person leading. The president, one person has this massive effect on everyone. And the risk is oftentimes we get too caught up in that one event and we're trying to look behind and go, well, what is he actually trying to achieve? What's actually going on here? And what's going to be the outcome? And that's where you go behind the scenes and you work in the subconscious. You're not focused on what's trending. You're focused on the subconscious. What are all the smart people thinking, and how's trade going to balance out, right? And that's anyway, that was just me trying to explain, because I think people half think I'm crazy for talking about cellular consciousness and the way the brain works and all this. But for me, it's 100% a fractal of the way we work inside, the way we interact with our friends and family, the way we interact with the economy, the way groups cluster up. And then it leads into other discussions about banks and stuff like that, and the idea of predatory lending and just the way cancer grows in the body. There's all these amazing fractals into it. But let me try to get to a question here after I've.
Well, let me just respond to that, because there's a lot of questions in there, and I want to take it back to markets a little bit.
Okay, cool.
So what you talked about is that conference, right? So what I think is one of the keys of what I've learned in the last 20 years is that to measure groupthink, in other words, those clusters, and what we try to do with the bear trap support is we try to figure out, okay, how crowded is this trade? Because the groupthink is powerful, like you said. Those connectivities, those brain cells everybody wants that affirmation of their thesis. And so especially the artificial intelligence. And so we've been trying to measure, like, wow, this thing is really crazy. This is crazy groupthink. All the analysts are saying the same thing. All the conferences, then you get someone like Jensen, the CEO of NVIDIA, gets up there. He's just feeding those clusters. He's making them bigger and bigger and bigger. So what we try to do with the bear trap support is figure out, okay, what is the life of a narrative, and what is the size of that groupthink? And you got to be so careful as a risk taker if you're going to go against it. If you're going to go with it, then you have to know. Okay, you have to know exactly where the narrative is in the cluster. Like, if you can measure it, like, let me give an example. Like, one that I'm seeing recently is just very recent. This is, to me, the birth of a narrative. The biotech industry has been destroyed. There's not a lot. This reminds me of uranium and your leadership in 2020, 21. There was no buy-in. The cluster was there was no buy-in. There was no buy-in from the investment community on Wall Street. There was everybody giving up on the sector. And so in our Bloomberg chat, in our Discord room, because we have 1,000 plus investors in all these different countries, we can see the genesis of a new narrative. And one that I'm seeing of late is the biotech sector, and how potentially with a shift within the Trump team around artificial intelligence and being supportive of kind of like that whole process of taking a drug. And we're not talking about getting rid of the holy grail of clinical trials, but if you look at the whole scale of how long that is and how costly it is, if we focus AI into this sector, these companies can become much more profitable really fast. And I think that if you think about the clusters, and like you said, you talked about walking into a conference and going back to everything you just said, like, all the clusters are over here on AI and Jensen and the chips, and it's where all the energy is, and all the the most crowded trade, and everybody knows the numbers. NVIDIA hit $3.6 trillion valuation. The entire, now it's probably 2.6, something like that. The entire copper sector that's going to be necessary to support that growth is worth not even $600 billion, right? So you're talking about a fraction of a fraction of kind of everybody's over here. And so I think the next level of artificial intelligence is not just the copper names and the uranium names, but also like the applications of this AI and where is it going to make companies the most profitable? And so I can see right now in my institutional chat with the clients all around the world that the interest here in, say, biotechs from really incredible investors is growing, and it has not moved yet to the sell side or to the media yet. In other words, what I've seen over the years, Kev, in terms of you're talking about the energetic investor, you're talking about the brain, you're talking about crowded, you're talking about where is the life of that narrative, and with some of these trades like this one, I think it's like you're in like the first, second inning of, okay, that whole cluster over there focused on Jensen on stage. If like 30% of that comes over toward things like biotechs and the companies that are going to be made much more profitable, that's where the money's going to go over the next 5 years.
It's funny when you, I guess I had a couple things to comment back on for that one. It reminds me of how I used to always tell people, they ask me sort of what I do and how I do what I do as far as picking stocks. And I often sort of described it as I kind of half feel it like hearing a song on the radio for the first time. And I talk about, it could be a song like Achy Breaky Heart when it came out, right? And I didn't really like the song, but I damn well knew that like my mother was going to love it. And, teenage girls are going to love it. And the line dancing crowd was going to love it. And it's going to annoy me, but I could feel how it's going to resonate with a certain audience. And I felt like it's going to go to number one. And if I could have gone long the song, I would have.
Yeah.
You know what I mean? And it's the same thing. So when I look at stocks or a sector, I look at a theme and I'm like, that's a good story. And then I'm like, I think it's really hard to poke a hole in this story. And it looks like margins are going to increase. So that's going to, its margins are going to increase. And then, the PEs are low right now. That means there's going to be high growth. So you're going to get margin expansion, multiple expansion. This is, and it's hard to poke a hole in it. At least for me, I'd be like, okay, I've done enough work on it now. I'm going to start putting capital into it and at least try to get an initial rise and you get this confirmation out there when you see, it's just like if you think that this song is going to get popular and you see it played at a bar or at a party and a bunch of people stand up and they're typically the leaders of the group. And you're like, yeah, I know everybody's going to be dancing to this. 2 months, this is going to be the next, whatever. I remember I was in Korea when that Gangnam Style took off. And I was like, I came back to Canada and I was like, oh, play this. And everyone was like, Gangnam Style, that didn't sound very good. And I'm like, no, this thing's going off. And it ended up going everywhere, right? And it's the same thing. You can just see the energy it gives the crowd. And stock stories, sector stories do the exact same thing. You just have to train yourself to be wired to see, and for me, it's like I put myself in the seat of the broker who's going to push the story. And I'm like, yeah, brokers are going to push this. They could raise capital off this. Right? They're going to push this to their clients because they're going to be able to get trading volume. They're going to be able to up the targets on the stock. They're going to want to raise capital for example, if you mention uranium, I'll be like, yeah, they're going to want to raise capital to build mines. They're going to want to raise capital to build nuclear facilities. They're going to want to raise capital to, on and on and on. There's money to be made here. They're going to get behind the story because they can make money from it, and they're going to invest in it, and they're going to put the target price on it and away it goes.
As a young investor, people have such a hard time measuring. People don't know where that narrative is, or think about the song. Like you said, it's the same thing of the life cycle of a song, the popularity. People don't know when they're younger. It's more based on experience in terms of investing. It's like how broadly, but what's the broad buy-in of the narrative?
Yeah, that's why storytelling is so important in history, because when you start looking at the characteristics of past commodity, like say you're doing the commodities, you look at past commodity sector rallies and you're like, okay, this is what a bear market bottom looks like. It has all these characteristics and these patterns, right? And then bit by bit, you'll see that, oh, the big mines are depleting. It looks like the supply demand is going to flip, in the coming years. And you're like, it's maybe not here today, but it's close the hell enough. And given where valuations are, I'm stepping in. And then bit by bit, it ramps up and you start getting the euphoria and the frenzy and the margin expansion and the stocks go crazy. Like we're seeing in gold now, the stocks still haven't gone crazy, but the margin's sure there for these guys. And it's just a matter of time until the stocks kick in and start showing how cheap they are by, putting up their earnings. And then there'll be the big rush in. And then that's when you're like, okay, these are the signs of a bull market. Here's the pattern, right? The peak of a bull market euphoria, record margins, record participation, and so on. Now it's time to take profits and maybe look for something that's cheaper. And for me, this is one of the pattern that I identified in the late 90s and got me into resource investing. I said, I'm going to do this for the rest of my life. All I have to do is be patient and just look for these troughs, buy deep value, wait till it looks overvalued or at least fair valued, and then look again for another one and move from. And over my career, I've gone from the metals to the energy, like oil and gas and coal, and to the agricultural phosphates and potash, and who knows, it just doesn't matter. You just keep moving around to where the low margins are. And that's something you've written about in your book as well. In the I should probably get to your new book, How to Listen When Markets Speak. A strong message I think that I got from reading it was that we're heading into this. It's the end of the bull in tech, somewhat, at least maybe a lost decade coming, similar to the peak of 2000s, where the margins are already too high, or they're unsustainable, and the valuations and the market multiples are too high. And so there's going to be this rotation into resource-related commodities and other sectors as well that have just been, you want to look for what's out of favor and see that it's going to come back. So maybe just give us an overview of your book and your view on where things are at today, and thinking about the decade ahead, the decade behind and the decade ahead, how Larry sees it.
Right. Well, I think there's a whole bunch of foundational points of the book. One is a multipolar world. One is unsustainable debt and leverage in the system that has to be financed. But in a multipolar world, it's a unipolar world, which we've had the last 30 years, 30 years, is where the United States is the central power. Your global supply chains are smooth as silk. And you're in a very disinflationary world in that environment. There are global wars, global conflicts, there weren't as many. And so a unipolar world is a world where the United States is that superpower and everybody else is along for the ride. The United States keeps levering up. Doesn't matter. The Fed was buying the debt. And we went into this real low interest rate, low inflation cycle that was very powerful. And it created an incredible whitewater river of asset allocation formation into the same trades. And because that's the playbook you need for that world, that disinflation, lower bond yields, you need this type of portfolio over here, which we can talk about. But once you move into a multipolar world that has more global conflicts, higher debt levels that needs to be financed, and in that multipolar world, you've got less friends globally to buy your bonds potentially. And if the Fed may or may not be there, then there's a lot more pressure on higher yields. So we get into the book what's called the DCF model. And this is right up your alley, because what happens is if you're in a long disinflationary period, nobody cares about the DCF model, discounted cash flow model, because all we're really talking about is if you're in that certain deflationary low bond yield world, you want to be invested in growth stocks. The DCF model is based on the risk-free rate. And so this is what all of Wall Street uses, is this type of model to value companies. So in that certain deflation world that we talk about in the book, those software companies, those growth companies, they can have incredible valuations because the risk-free rate is right near zero. And If you're in a growth company and it's certain deflation, your future profits, there's no threat to them. But once you move into a multipolar world, more global conflicts, higher debt levels, higher higher interest costs, then that risk-free rate is higher, and therefore that more expensive risk-free rate. So think of like a company, a software company, and you're going to have more certain inflation and certain higher bond yields, then the net present value of all your future cash flows is worth a lot less. This is what we talk about in the book. We simplify it. So you got a company that's a software company in an inflationary world, and it's a growth company. And over the next 10 years, because of inflation and higher bond yields, that cash flow that company is going to produce is going to be worth a lot less. And so what happens in different regimes is from, say, 1968 to 81, that was your multipolar world, higher interest rates. And there was a colossal shift into companies that own assets. Because if you're a gold mining company or an oil company or a copper company and you're a resource company and you've got that DCF, certain inflation, certain higher bond yields, money analysts on Wall Street over time are going to reposition money into those types of companies away from the software and the growth stocks and the Mag 7 type companies. And so, but because of passive investing, which is, I think, pure evil we can get into, it's gone, once it gets above a certain level of market share, it's basically prevented this rotation to some extent so far, because we've been in this inflationary regime since 2022, and the rotation has barely happened. It has happened, especially the last couple of months, but that's kind of the core thesis of the book, is moving from that the unipolar world, low inflation, low bond yields, to that multipolar world, global conflicts, higher interest rates, and that great rotation out of what we call financial assets, paper certificates, into more companies that control hard assets.
I look at quantitative easing. I look at what's happened with the US dollar. It became the reserve currency. You know, the first big broken promise, 1931, they're like, no more convertibility of the dollars to gold for citizens. 1971, US says, screw you. You can't, foreign central banks, you can't convert to gold anymore. And then we go on this massive run of the 70s, right? Is because the reserve currency of the world is no longer convertible. The promise of how these people are going to get paid back that accumulated all these dollars. And when the Federal Reserve just quantitative eases, it's the third default. Because you should, as a foreign owner of bonds, you should say, okay, I'm willing to hold these bonds because I expect you to tax you're supposed to produce goods and services in your economy, and you're supposed to tax your people. And these dollars represent that tax, and this debt represents that tax, and so that way you're gonna pay back your debt with goods and services. But if you're just hitting keys on a keyboard and creating, I guess they monetized 8 trillion at one point, but only 5 trillion of government bonds, but they brought all this onto they call it a balance sheet, and I call it a ledger. It's an asset ledger. There's no it doesn't balance.
No, it's not a balance sheet.
It's not a Fed balance sheet. It's a historical ledger of what they've monetized. And in my mind, it's like, why not just look up the QSIP numbers and delete the bonds they've bought? Because you're just paying interest to yourself. It's like me saying, hey, Larry, I lent myself $1 billion last week. I'm $1 billion in debt, but don't worry, I got $1 billion in assets. Like, who cares? Right? And that's what I see is one of the things that people aren't looking at enough is everyone, especially the US media, they're so US focused, and they're like, your guys are ripping us off. And meanwhile, it's like, oh, wait a second, you've been buying, inflation adjusted, the historical purchase, at $46 trillion worth of stuff you've got has been sent in boats to America over the last 60 years, and they paid for it with, like, that's what they've done.
Yeah.
And the rest of the world ripped them off. There's people working in sweatshops, and they get some dollars that are run off a printing press, and then we just print it away. We're just going to print the debt away. And so I look at that, like, from the perspective of these other nations, the Trump administration is making a big mistake in some ways of shining a light on the trade situation. And then if you're going to try to force people to settle up now, like as a Canadian, I'll be like, okay, so what am I going to do? We've been selling you this cheap oil, and we're fine with it. because we take your dollars and we spend them in China and we buy cheap stuff. We buy iPhones and whatever, right? As it flows through our economy. But if you're going to make us sell you cheap oil and then buy expensive shit from you, it doesn't work. We need to put a pipeline to the coast and we need to sell it to China. Okay. Like that's what's going to happen. Anyway, I threw out way too much there, but why did it done? I just want you to talk about the idea of the money creation system between the fractional reserve, the bank doing it, and then them earning this interest without work, and then the government. In my mind, it's a default. It's another form of default. And if we can't trust you to pay back the debt with taxes, and you're just going to print it in a matter of time, like why would anyone want to hold it, the uncertainty it raises about the inflation adjusted return? I mean, 4%. If you're going to monetize, if the world starts thinking we're guaranteed to lose in these bonds, like the 8 trillion of bonds held by foreigners, they're guaranteed to lose. You're like, oh, I'm out of here. I'll buy something else, right? Anyway,
Yeah, so
roll with that.
to me, the current crisis is Trump and Biden combined. The Biden team juiced the fiscal. So one of the lines from my book, I think is the most powerful, How to Listen When Markets Speak, is the fiscal and monetary response to Lehman Brothers. That's fiscal and monetary. So all the Fed purchases plus the fiscal spending was about $4 trillion. The fiscal and monetary response to COVID, the regional bank crisis of 2013, and Biden, the Biden team juiced the fiscal into the 2024 election, at least another $2 trillion of fiscal, and then another trillion of deficit spending in the first quarter of this new year, which is the way it works is the outgoing president gets to spend money in that first quarter before they leave. So Biden brilliantly, and then Biden and Yellen brilliantly kind of sandbagged Trump because they were juicing. So interest as a percentage of tax receipts got up to around 20%. Interest as a percentage of tax receipts. Now, the rest of the developed world, Germany is down at 2%, France maybe 3-4%. So other developed countries, your interest costs as a percentage of tax receipts is anywhere between 2 to 5 or 6%, maybe 7. Whereas the United States is been approaching 20. So, and then came Trump trying to finance this through essentially tariff taxing our counterparties. That creates some, with that sledgehammer and the way he delivered this, and then this Rose Garden clown show with the Navarro and Lutnick's formula. They just freaked out the planet Earth, right? So you had a great bunch of nervous investors globally. They were already nervous about the debt in Washington and bipartisan. You can't blame it on the Democrats. Kevin McCarthy is the one that allowed Biden to do that, right? Through increasing the debt ceiling about 18 months ago, 2 years ago. So it's these investors who were freaked out. Trump hit them over the head with this tax hike, which is a tariff. And so that gets into global investors and the formula that you're talking about, where we've had 30 years where global investors had to buy our bonds. And now we're coming to a period where we've got fewer friends on earth, that the Fed's going to be forced within the next, I think, year to come in and support the bond market, because that interest, if you go into a recession, Kevin, and that interest, I love your philosophy of the way you look at it, but let's just look at it from like investing. If your interest costs in a recession go down, your interest as a percentage of tax receipts might actually go up to 30%. And so therefore, you're going to get downgraded by the rating agencies. You're going to create more fear, and that forces the Fed in. That's where you get the big, incredible.
When you say support, when you say support, you're saying the Fed's going to have to basically cut rates and probably start monetizing bonds again, which.
But yeah, buying bonds, by like being so what if you look at the auction sizes of 2-year bonds or 5-year bonds? These auction sizes, like in 2019, used to be like 10 billion, 5 billion, maybe 15 billion. Just normal auctions, bond sales. Now we're like 50, 60, $80 billion auctions, Kevin. Like who's going to buy these things, right? And
Well,
so,
they play the game with the banks. That's what I was sort of saying is
right,
the fractional reserve system is here, banks, you can buy it. And by the way, you don't even need capital. You could just hold this stuff. Just banks collect the interest, buy our bonds, collect the interest. And then you've got the situation now where taxes are just flowing to bankers' profits because they can buy the bonds with no capital.
right. And that's where we get into the book, the SLR. So all financial repression means, when you have a $37 trillion debt hole, there's only two ways out. There's a debt jubilee, which is we talk about the civilizations, and I'm sure you talk about in your book around civilizations the last 2,000, 3,000 years. There's been debt jubilees. A simple one would be just Argentina, constantly defaulting. In the Bible, they talk about just a big reset. Or you can monetize the debt through financial repression. And all that means is keeping interest rates below the rate of inflation or massaging the rates below the rate of inflation. The Fed would do that by buying bonds of QE, and that's what's going to happen. And that creates this new, because then you get a much weaker dollar, and that creates this new. Isn't that the furnace or the foundation behind the next commodity bull market?
Yeah, and like they need to make GDP grow quicker than the debt. Right? You have to have the GDP outgrow the debt. Otherwise, you're leading to this deflationary collapse. And to your argument about what happens with deflationary collapses, if you start going into a recession and you start seeing your receipts go down, your tax revenues go down, capital gains disappears, property taxes fall with real estate prices falling, corporate profitability falls, like everything on your income side goes down, and then your entitlement payments go up, and you're trying to boost the economy with fiscal stimulus, you end up with a blowout deficit again. And by the way, you mentioned the 2008, 2020. I was looking back, 1929, and looked at the deflation we had then. Relatively small fiscal stimulus as a percentage of GDP. And that's why GDP shrunk. If you're going to do what we did in 2020, the Fed has established this precedent. 2000, they established it. The dot-com sector, NASDAQ's melting down. 2000, they established a precedent, right? Economy falls apart, stock market blows up. We're going to cut interest rates. We're going to do fiscal stimulus. We're going to rebound the market. Bigger blow up happens 08. Right, 07, 08, we're going to cut rates down to zero, and we're going to really, really do a combination of quantitative easing and fiscal spending. And then I can't remember the number off the top of my head, but the deficit spending as a percent of GDP in 2020 was off the charts. And so I always sort of go to people and say, look, you want to have this inflation deflation argument. If a government wants to, it will prevent deflation. All it has to do is just crank up fiscal spending, cut rates to zero so they lower their interest, buy back bonds, they can destroy their interest expense, right? Because when the Fed buys bonds, right, the interest they collect, they credit back to the Treasury. So they're, in fact, like it's virtually gone, even though I always say to people, you might as well just take 4.7, 4.8 trillion off the debt right now. If the Fed wants to sell them back to the market, it's the same as the Treasury issuing it. It doesn't matter. You might as well just cancel them. And then if you're actually going to do it, which I don't believe they're going to do it, because I think they're going to, you and I both are saying they're going to have to buy more, not less, as we look forward here, right? And I just think that's going to freak the hell out of the foreign holders of debt, because I actually sat with the head of NPS, the third largest pension fund in the world at the time in Korea. And I had this conversation. I'm like, what are you guys doing? Like, why are you loading all this, all this great stuff, Samsung and, these car manufacturers and all these electronics, you're sending all this stuff over and you're just piling up treasuries. And I said, they're just going to print it away. And the guy argued, oh, no, well, they taxes, and they believed that they were going to get a real return. They actually believe they're going to get a real return. And I'm like, more and more, they're going to flip over to what we saw in the 70s, when those articles were written actually near the peak of the bull market in the 70s, right? The commodity bull market, the gold bull market. The articles at the time were saying U.S. government bonds are articles of confiscation, that they're guaranteed to lose. And that's the narrative I think that we're going to see over the next 10 years is if you own US debt, you're going to lose because the rates are so low, they're forcing you to lose in real terms. And it's just going to lead to more and more foreign holders selling. And we're also going to miss out potentially on, if you try to close that trade deficit, if you think about it, all the people that were making profits, especially offshore profits, like Chinese companies and Chinese traders that don't want to show profits in China, they'd show them in Cayman Islands or somewhere, right? Or down in Panama or whatever. They set up these trading companies in different parts of the world, right? And so they keep their profits offshore, but they typically try to get them into either owning US bonds or they buy ETFs, big ETFs, and they just park the money in the stock market, creating the bubble. Anyway, we should probably wrap up. I'd love to chat with you again because there's so much I could go into, and I want to pick your brain. I was trying to get to. It's funny. There's a lot of crossover on our books.
You look at things from 20, 30,000 feet, and more people should do that, you know.
Well,
But
it's for me, Larry.
yeah,
I'm at the point where I just want to make the 10-year trades. You know, I don't need to outperform. I just don't want to get hurt badly by inflation. If I could just get slight real returns, if there was a sane government that I could trust, that I could just buy some bonds and know I'm going to get a real return, that's good enough for me.
right.
I'd rather go fishing and hiking. But
Yeah,
I've got to look at this market because it's so crazy, and I got to go, where am I going to put how can I just protect my savings? I just want a freaking store of value.
right. Well, thanks for doing this. Let's do it again.
Yeah, I'd love to. I really appreciate it.
Okay, thanks, Kev.
All right, take care. Have a good day.
Okay.
So that concludes today's episode. Thank you very much. I hope you enjoyed it, and please like and subscribe. Show me you care, and I love reading your comments. Take care. Have a good week.